The most dangerous lie is the one dressed in a suit, carrying a briefcase and quoted on the evening news. We are taught to fear the thief in the alley. History teaches something darker. Fear the man the system trusts completely. In 2002, $11 billion vanished. Not stolen in darkness, but recorded, reported, and applauded in the light. This is not a story about one corrupt man. It is a story about what happens when an entire system chooses not to see. The year is 1983. In Clinton, Mississippi, a modest town most Americans couldn't place on a map, a small phone company is quietly born. LDDS Communications, Long Distance Discount Service, an unremarkable name for what would become the most audacious fraud in American corporate history. Its leader, Bernard Ebbers, a former basketball coach and motel owner, no finance degree, no Wall Street pedigree, just relentless ambition and a gift for making people believe. Through the 1980s and 90s, Ebbers acquired over 60 companies. Each deal funded the next. The machine needed to keep moving or it would collapse under its own weight. By 1997, LDDS had become WorldCom. Its stock was Wall Street's darling. Analysts cheered. Funds piled in. The story seemed too good to question. In 1998, WorldCom attempted to acquire MCI, then the second largest long-distance carrier in America. A $37 billion deal, the largest merger in U.S. history at that time. The MCI merger was approved. WorldCom now controlled a third of all U.S. internet traffic. It was no longer just a phone company. It was infrastructure itself. At its peak, WorldCom's stock traded at $64 a share. Ebbers was worth nearly $1.4 billion on paper, Mississippi's most celebrated businessman, untouchable, unquestioned. But beneath the headlines, the telecom industry was quietly crumbling. The dot-com collapse had decimated demand. WorldCom's revenues were falling, and the truth was becoming dangerous. Ebbers faced a crisis no acquisition could solve. Analysts expected growth. Investors expected growth. The stock price demanded growth. There was no growth left to find. The solution came from inside the CFO's office. Scott Sullivan, Harvard-educated, meticulous, respected, he found a way to make the numbers say whatever the market needed to hear. The method was elegant in its deception. Operating costs, the fees WorldCom paid to use other companies' networks, were quietly reclassified as capital expenditures. This single accounting trick transformed billions in losses into apparent profits. Quarterly, consistently, for years. Filed with regulators, audited by Arthur Andersen, approved. Arthur Andersen, the same auditing firm that had just missed Enron's collapse months earlier, signed off on WorldCom's books without meaningful challenge. The gatekeepers had fallen asleep. Meanwhile, Ebbers was borrowing hundreds of millions from WorldCom's own board, personal loans secured against his company's stock, to fund a ranch, a timber business, and a marina. The board approved every loan. No independent objection, no external scrutiny. A company of 80,000 employees was being quietly hollowed out, and nobody in power chose to look. By early 2002, the fraud had reached $11 billion. But inside WorldCom's internal audit department, one woman had begun asking questions nobody wanted answered. Cynthia Cooper, internal audit vice president, working nights, working in secret. Piece by piece, she reconstructed what the official numbers had been designed to hide. She was warned, pressured, told to stop. Scott Sullivan himself asked her to delay her investigation. She continued anyway. Some people, when they see the truth, cannot unknow it. In June 2002, Cooper presented her findings to WorldCom's audit committee. The numbers were irrefutable. $3.8 billion in fraudulent entries. The committee had no choice but to act. On June 25, 2002, WorldCom announced it had overstated earnings by $3.8 billion. Within hours, the stock, once worth $64, was trading at pennies. 80,000 jobs hung in the air. On July 21, 2002, exactly 26 days later, WorldCom filed for bankruptcy. $107 billion in assets, the largest bankruptcy filing in American history, a record it would hold for 2 years. Pension funds across America, teacher funds, police funds, municipal retirement accounts held WorldCom stock. Ordinary people who had never heard of Bernie Ebbers lost everything. Bernard Ebbers was arrested in 2002, tried in 2005, convicted of fraud, conspiracy, and filing false documents, sentenced to 25 years in federal prison. He was 63 years old. Scott Sullivan pleaded guilty and cooperated with prosecutors. Arthur Andersen, already mortally wounded by Enron, surrendered its accounting license. An industry's credibility collapsed alongside the company. Cynthia Cooper was named one of Time magazine's Persons of the Year in 2002. She received no bonus, no promotion. She had simply done what every person in that building should have done. WorldCom is gone. The buildings were sold, the name erased. But the conditions that created it, the incentives, the blind trust, the willful silence, those were never dismantled. Sarbanes-Oxley was passed. New rules, new certifications, new penalties. And yet, Lehman Brothers collapsed 6 years later. MF Global, Wirecard. The fraud never stopped. Only the names changed. The question history keeps asking and we keep refusing to answer is not how these frauds happen. It is why we are always surprised when they do. Because every generation believes it is smarter than the last. Every bull market feels different this time. Every charismatic leader seems too compelling to doubt until the moment they don't. WorldCom's collapse cost ordinary investors and pensioners an estimated $180 billion in lost wealth. Not Wall Street, not hedge funds. Teachers, firefighters, retirees, people like you. So what do we do with this knowledge? We build walls, not from fear, but from clarity. These are the laws that WorldCom's victims never had the chance to apply. Law 1. Never trust a story that cannot be questioned. WorldCom's growth narrative was celebrated, never stress-tested. Applause is not analysis. Consensus is not proof. Every analyst on Wall Street covered WorldCom. Most rated it a buy until days before the collapse. Credentials do not equal independence. Ratings do not equal research. Before you place serious money anywhere, ask one question. What would have to be true for this story to be wrong? If nobody around you can answer that, walk away. Law 2. Complexity is often a weapon. WorldCom's fraud survived because the accounting was deliberately difficult to follow. When you cannot understand where the money is, that is the warning. Sophisticated investors lost billions in WorldCom, not because they were foolish, but because they confused complexity with credibility. A complicated story is not a sound story. The rule is ancient and unchanged. If you cannot explain where your money is and how it grows in plain language, you do not yet understand your own investment. Simplicity protects. Law 3. The auditor is not your protector. Arthur Andersen audited WorldCom. It audited Enron. Both collapsed under its watch. An audit is a commercial transaction, not a guarantee. Auditing firms are paid by the companies they audit. That single fact contains everything you need to understand about the limits of their independence. Follow the fee, find the bias. This does not mean audits are worthless. It means treat them as a starting point, never an end point. Your own scrutiny must go further than any document stamped and filed by a hired firm. Ask instead, does management own significant stock? Are insiders buying or selling? Is the board truly independent? These questions cost nothing. The failure to ask them cost WorldCom's investors everything. Law 4. Debt borrowed against inflated assets is a trap with a timer. Ebbers borrowed $400 million against WorldCom stock. When the stock fell, the collateral vanished and the debt remained. This is the oldest trap in the history of wealth. Assets feel permanent when they are rising. Debt is permanent whether they rise or fall. The asymmetry always favors the lender, never the borrower. The preservation of wealth across generations is built on one discipline above all others. Never allow debt to grow faster than the assets backing it. That gap, when it opens, becomes a grave. Examine your own position with honesty. What do you own outright? What exists only because of borrowed money? The answer to those two questions tells you more about your financial safety than any market forecast ever will. Law 5. Institutional size is not institutional safety. WorldCom employed 80,000 people. It controlled a third of America's internet. It was considered too embedded to fail. It failed completely. We are conditioned to believe that large means stable. History disagrees, violently. The Roman Empire, the British East India Company, Lehman Brothers. Size amplifies collapse. It does not prevent it. Diversification is not a preference. It is a structural defense against the illusion of permanence. No single company, regardless of its size or story, deserves more than you can afford to lose entirely. The pensioners who lost everything in WorldCom had one thing in common: concentration. Their entire retirement rested on one name, one stock, one story, one lie. Spread the weight, always. A portfolio built like a fortress has many walls, not one. If one wall falls, the structure holds. This is not pessimism. This is the architecture of financial survival across generations. Law 6. Whistleblowers are the market's immune system, and we must learn to listen before they are silenced. Cynthia Cooper warned. She was pressured. Had she been stopped, the fraud would have deepened. In every major fraud in history, someone knew, someone saw. The question was never about the evidence. It was always about whether the culture allowed the truth to surface without destroying the messenger. As an investor, seek the dissenting voice. Find the analyst who disagrees. Read the short seller's thesis. Not because they're always right, but because they're asking the questions nobody else will. The crowd is not your compass. Markets move on consensus, and consensus is often the last to know. Independent thought is not contrarianism. It is the oldest form of financial self-defense. WorldCom's board had 16 members. Not one raised a formal objection as the loans to Ebbers mounted. Silence in a boardroom is not neutrality. It is participation. Judge institutions by what they permit, not what they proclaim. We've walked through the wreckage of WorldCom. $11 billion, 80,000 jobs, millions of shattered retirements. Now we ask the only question that matters. What do we build from here? The goal of financial wisdom is not the accumulation of wealth. It is the accumulation of options. The freedom to say no. The power to wait. The security to choose without desperation clouding the decision. WorldCom's victims did not lose merely money. They lost time. Irreplaceable years of compounding, stolen in weeks. Time is the one asset no court, no settlement, and no recovery can ever fully restore. This is why protection must always precede growth. Not as a concession to fear, but as an act of respect for the time you have already spent building what you have. Guard it accordingly. The wealthiest families in history, the ones whose wealth survived wars, depressions, and currency collapses, shared one philosophy. They were obsessed not with how much they could gain, but how little they could lose. They held real assets, land, gold, productive businesses with tangible revenues. They were skeptical of paper promises and slow to trust financial innovations they did not fully understand. Caution was their inheritance strategy. You do not need to predict the next WorldCom. You only need to build a life and a portfolio resilient enough that when it arrives, and it will arrive, you are not among its casualties. Resilience is not built in moments of crisis. It is built in the quiet years. The years when nothing seems urgent, when markets are rising, and when caution feels unnecessary. Those years are the most dangerous of all. The ancient Romans had a phrase spoken to generals returning in triumph. Memento mori. Remember you are mortal. Remember this glory is temporary. For investors, the equivalent is simpler. Remember every market is temporary. The bull market that made WorldCom's fraud possible lasted nearly a decade. The collapse that exposed it lasted weeks. Fortunes built on a decade of optimism were erased in days. The speed of loss always exceeds the speed of gain. There is a kind of peace that money alone cannot buy, but that money managed wisely can protect. The peace of knowing that whatever happens in the markets tomorrow, your foundation will hold. That foundation is not built from tips or timing or the right stock pick. It is built from principles, repeated quietly across years. The same principles WorldCom's victims never had the chance to apply. Question every story, demand simplicity, never outsource your scrutiny entirely, respect debt's permanence, diversify without apology, and listen always to the voice that dares to dissent. These are not complex ideas. They never were. The complexity was always introduced by those who needed you distracted, who needed you trusting the story rather than examining the foundation beneath it. Bernard Ebbers died in prison in 2020. He had served 13 years of his 25-year sentence. His billions, borrowed and fraudulent, were gone long before he was. Hubris always presents the bill. Always. Cynthia Cooper still lives in Clinton, Mississippi, the same town where WorldCom was born. She lectures, she teaches, she writes. The woman who told the truth continues to tell it. Integrity compounds too. The world will produce another WorldCom, a different name, a different industry, a different decade. The fraud will be dressed differently, but the architecture beneath it will be identical. It always is. Your protection is not prediction, it is preparation. A portfolio built on honesty, a mind trained in skepticism, a spirit unbothered by missing the crowd's excitement. These are the weapons history recommends. True financial freedom is quiet. It does not announce itself. It does not require validation. It simply means when the storm arrives, as it always does, you have already built your shelter. You are already safe. WorldCom is a name most have already forgotten, but the lesson it left behind, for those willing to learn it, is worth more than everything Bernard Ebbers ever claimed to own. Remember it. Protect accordingly.